Welcome to today's What Will Move the Market show. I'm your host Prem. It's Friday, January 16th, 2026, and here is everything you need to know as the markets open for today. Let's start with what happened on Wall Street overnight on Thursday. After 2 days of losses earlier in the week, markets rallied smartly yesterday. The Dow Jones Industrial Average climbed 493 points to close at 49,442, posting a solid 0.6% gain. The S&P 500 rose 0.26% to 6,944, while the Nasdaq was up 0.3%. The real story though was in semiconductors. Taiwan Semiconductor Manufacturing Company, the world's largest contract chip maker, absolutely smashed expectations on their fourth quarter earnings, and that sparked a huge rally in the entire chip ecosystem. Companies like ASML, Applied Materials, and AMD all surged significantly. On the banking side, Goldman Sachs reported record annual revenue and jumped over 4%, while Morgan Stanley climbed 6% on strong results. The Russell 2000 Small Cap Index outperformed for the 10th straight session, a remarkable run of outperformance not seen since 1990. Oil prices collapsed 4% on indications that tensions between Washington and Tehran may be easing. Jobless claims fell unexpectedly, suggesting the US labor market remains surprisingly resilient. However, let's be clear on the week-to-date picture. The S&P 500 is down 0.3%, the Nasdaq is off 0.6%, and the Dow is slightly negative, so Thursday's rally still hasn't fully recovered the week's earlier losses. Now let's look at how Indian stocks fared overnight. Infosys ADR retreated 2.74% to $18.82 following their third quarter results announcement yesterday afternoon. The company did raise its full-year revenue growth forecast to 3 to 3.5% in constant currency, which was positive. However, net profit fell 2% year-on-year to 6,654 crores, weighed down by a 1,289 crore exceptional charge related to new labor laws implemented in India. HDFC Bank ADR slipped 1.25% to $32.51. ICICI Bank ADR declined 0.8% to $30.82. Reliance was the lone gainer among our major Indian ADRs, climbing 1.08% to $65.70. The weakness in banking and IT stocks reflects ongoing caution among foreign investors navigating the combination of domestic earnings challenges and geopolitical uncertainty. Here's what's happening across Asia as we head into the Indian market open. The GIFT Nifty is trading essentially flat near 25,800, suggesting we'll see a muted opening for our benchmark indices this morning. The Nikkei 225 in Japan is down 0.42% at 54,110. Losing 230 points as Japanese tech stocks feel the weight of overnight selling pressure. Hong Kong's Hang Seng is expected to open higher based on early indications, while China's Shanghai market is trading mixed. Australia's ASX 200 already posted a 0.28% gain in early trading. The subdued GIFT Nifty reading tells us that despite the positive close on Wall Street, Indian traders remain hesitant to commit fresh capital until there's greater clarity on several fronts. The technical picture suggests the Nifty could consolidate in a narrow range through the day, with key support at the 25,600 level and resistance capped at the 25,800 to 25,900 zone. Any decisive break below 25,600 could accelerate selling pressure toward 25,500. Conversely, a sustained close above 25,800 would signal renewed buying interest, though the broader resistance remains formidable at the 26,000 level. On the global geopolitical front, we have major developments affecting investor sentiment. US President Trump announced yesterday that countries doing business with Iran will face immediate 25% tariffs on all US transactions. This is significant because Iran's primary trading partners, China, the United Arab Emirates, Turkey, and India, would all be affected. There are ongoing violent crackdowns on anti-government protesters in Iran, and Trump has indicated that military intervention remains a possibility while also expressing openness to talks. There are also ongoing discussions about Trump pursuing an acquisition of Greenland, with estimated costs potentially reaching $700 billion. Meanwhile, the United States and Taiwan announced a significant trade deal whereby Taiwanese chip and technology companies will invest at least $250 billion in enhancing US manufacturing capabilities. These geopolitical moves are creating uncertainty, particularly around tariffs and trade relations, which is weighing on emerging market sentiment globally and keeping foreign investors cautious toward India. Domestically, beyond the Infosys results, several key developments are shaping sentiment. First, the Union Budget will be presented on February 1st, with the parliamentary budget session running from January 28th through February 13th, then resuming March 9th through April 2nd. That's obviously a calendar marker for traders. Second, the ongoing foreign investor selling remains a headwind. We've seen cumulative net outflows of over 11,700 crores so far in January, continuing last year's troubling trend of over 166,000 crores in annual outflows. However, domestic institutional investors have been strong buyers, absorbing much of this selling and providing a crucial support layer. Third, watch for any announcements on the delayed India-US trade negotiations, as progress there would likely lift sentiment meaningfully. The Infosys guidance increase, while positive on the surface, masks some underlying earnings quality concerns given the exceptional charges from new labor law implementations. This is worth monitoring as other IT companies report their own results. From a technical standpoint, here are today's key levels. The Nifty 50 faces immediate support at 25,600, with a secondary support base at 25,500. Resistance builds at 25,800 and 25,900, with the major overhead hurdle still sitting at 26,000, where heavy call writing has accumulated. For the Bank Nifty, support is anchored at 59,300 and 59,000 respectively. Resistance forms at 59,500 to 60,000, with the 59,300 to 59,500 zone representing a critical range where the index must prove its footing. The India VIX, a volatility measure, is elevated at 11.32, up 1%, indicating that while not in panic territory, intraday swings could be sharper than average. This suggests stock-specific action and sector rotation may dominate the day, with traders being selective rather than making broad index bets. On commodities, crude oil continues its weakness, trading flat at $59.16 per barrel, having fallen nearly $3 from earlier levels. This easing in oil prices should be supportive for India's import bill and headline inflation. Gold retreated 0.2% to $4,606 per ounce, while silver was down 0.88% to $91.58 per ounce. Both precious metals are cooling slightly after recent record rallies, though the underlying tone remains supported by geopolitical risk. Natural gas edged up 0.26%. The overall commodity picture suggests investors are pricing in some deflation expectations alongside geopolitical premium in safe havens like gold. Here's my action plan for traders and investors today. Friday is typically a day when traders lock in positions ahead of the weekend close, so expect potentially lighter volumes and range-bound behavior unless we get a catalyst. First, for bulls, any weakness toward the 25,600 support zone should be treated as a potential buying opportunity for a tactical bounce toward 25,700 to 25,800. Do not aggressively chase here without confirmation above the key resistance. Second, for bears, rallies toward 25,750 to 25,800 offer sell opportunities with stops placed above 25,850. Third, given the FII selling pressure, focus on quality large-cap and mid-cap stocks with strong domestic demand and earnings visibility, as domestic institutional buying should continue to support fundamentally sound names. In the banking space, use any weakness in HDFC or ICICI as dip buying opportunities given their valuations and dividend appeal. For commodity traders, crude oil at $59 shows support, but a break below 58 would open the door to further weakness toward 57. IT sector remains a trade that favors caution until we see more earnings clarity post-Infosys. The broader takeaway is that this remains a range-bound consolidative market where risk-reward slightly favors the downside if the key 25,600 support cracks. But the overall backdrop remains constructive for disciplined buyers on dips if macro developments like trade progress or geopolitical de-escalation emerge. Stay tuned for the evening wrap where we'll track how Asia closes and how our own indices perform throughout the trading day. Send in your market questions through our website or social channels, and don't forget to subscribe to this podcast so you hear from us every single morning. Have a fantastic trading day, and remember, stay disciplined, respect your levels and trade with conviction. This is Prem signing off.